You clicked on this video because you found long-term or swing trading difficult, or it just doesn't resonate with you. And you found scalping, which involves taking trades and holding them for a relatively short period of time. But you seem to still be taking stupid losses and have found zero success with scalping. And you ask yourself, is there something I'm missing? Yes, you're skipping very vital things. I failed at swing trading and struggled with scalping until I found these secrets. Back in 2021, I was trading a trendline strategy that made me trade off higher time frames, and in turn, I held trades for very long periods. At first, it seemed successful and I made some profits, but as time passed, I started losing consistently. My setup took weeks to form, and most times, I'd be in a trade for 2 weeks only to get stopped out in the end. And back then, prop firms had a 30-day limit, which then made me take setups that are not ready or risk too much on them when they eventually come, and I kept losing. Later on, I found out that I wasn't losing because my system was bad, but because the system requires trading in a particular way that wasn't resonating with me. After I learned a scalping strategy, I started to see some difference, but I still wasn't profitable with it. And that was because I had zero idea on the scalping secret I'm going to be sharing with you. I was scalping with the mindset of a swing trader, which is wrong. The secret which brought the pieces of the puzzle together is understanding where we are in the market and what is the closest destination. You can refer to them as low-hanging fruits. At least that's what I still like to call them. You may not have a strategy that you can effectively apply this on, so I'll show you how to do this with a basic strategy. Before we go into applying this in the market, I need you to understand something. The market is fractal. Now here's what I mean. Usually, the market distributes in series of lower lows and lower highs in this case, or in series of higher highs and higher lows. Alright, you know this already, it's not something new. Okay, so if basically we had lower lows and lower highs, we're usually having break of structure to downsides consistently. Okay, and then the markets will retrace to at least, if we have this to be the swing, at least 50% before we know that that swing is complete. Okay, what I mean by 50% is if you take out a Fibonacci 2 and draw from the highs to the lows, it's going to be at least 50%. If we had the market do this, let's say this is like the higher time frames, so this could be the hourly time frame or the daily time frame or the weekly, whatever time frame now. On a lower time frame, would have the market, this is where fractality comes to play now, would have the market do something like this. So let's say we're coming to a fair value gap here. We're coming towards a fair value gap here. And we'll have this. We'll have the market create series of higher highs and higher lows. Okay, till it gets in there. And then coming back, we're going to still have series of lower lows and lower highs till we break structure, and then it goes on and on. Now let's change the color of this so you could understand what I'm saying. So now let's say the black arrows could be your 5 minutes and then the red is your hourly. But then despite the fact that market is doing this, on your hourly time frame, you're still going to just see one swing leg, price comes here, and then the move continues. Okay, on your hourly time frame, this is actually what you're going to be seeing. This is just going to be one swing leg. But on lower time frames, you're having series of highs taking out and lows taking out. Okay, you're having break of structure here on the 5 minute time frame. So you could have this here, you have a break of structure or change of characters at downside, and then price keeps breaking lows consistently and still returning to important points here. Understanding this, you know that your analysis should be based off the most recent swings on every time frame while you're stripping down. You should also take note that being a scalper does not mean you won't do a top-down analysis before getting into your entry time frame. If you don't understand this, I'll show you an example from the trade I took yesterday. Following the most recent swings in the market would enable you have a clear anticipation of what the market is likely to do next. So in each case, this is the most recent swing when we had these highs and these lows taken out. This became the most recent swing. And then here too, we had, after price retraced and took out these lows, this became the most recent swing, same as this now being the current swing that we are in. Okay, if you have a system that allows you catch reversals like this, very beautiful. This is a trade I took yesterday. To be able to take this trade, I just applied everything I showed you with fractality and being in the most recent swing. Now let me run a top-down analysis to make sure that you guys understand what I mean by a top-down analysis. I'll start from higher time frames all the way to my entry time frame, and then show you that, okay, this is actually still a scalp trade, but that does not mean I'm excluding higher time frames or top-down analysis. And that does not also mean that I am not trading in line with the current swing of the market. So let me strip it down to a clear chart. This is a clear NAS 100 chart. And then let's see. Now, higher time frames, I usually will start from the daily time frame. So on the daily time frame here, pay close attention so you can get something off of this. On the daily time frame here, this was where we are. This was yesterday. Okay, this was yesterday. So we are basically just having a bull run. There's nothing behind. The market is just really bullish. So there's not much analysis I could do from the daily time frame. Versus if we were somewhere like this, I could have some things to do. Okay, but then we're in a very, very weird position, which is fine. We just have to strip down a little bit more to understand where we are. Okay, so that I just go to the 4 hours. In the 4-hour time frame, we're making some sense here. We're making some sense. The most likely place price is going to come to on 4 hour is this fair value gap. So let me mark that out. So let's make this FVG. And then mark out the one up top too. So yeah, that's our 4-hour fair value gap. The nearest direction that price would head towards is this, because ideally this is where we are at the time I come into the market around 8. So this is where we are on this candle. So then mind you, this fair value gap was just forming. So that's the information the 4-hour has to give us. I'm really not interested in taking price all the way down, because it would take time for price to come and retrace all the way here. That's not my business. My business as a scalper, when I'm watching every time frame, I know that my business is the most likely thing price is going to do next. Not trying to follow the whole swing. No, we're looking for how to catch a trade in 30 minutes. In 30 minutes or in less than an hour max. Okay, and this is a 4-hour candle. So think of this. How many 4-hour candles are you going to have before price retraces? So when you understand that a lot of traders will avoid higher time frames, feeling like, oh, you need to follow price a lot on the higher time frames. No, you just need higher time frames for direction's sake. You strip this down to the hourly time frame. On the hourly now, we're beginning to get closer to the lower time frames. On the hourly, we mark out our midnight open, New York midnight open. When we mark out New York midnight open, now this fair value gap that we marked from the 4 hours does not look like a fair value gap on the hourly, but then we know that, okay, there's a fair value gap. But rather, what we have on the hourly is relatively equal lows. So let's switch this from a fair value gap line to a liquidity line, which makes that relatively equal lows. And then it's not just any random equal lows. They're actually very important. This is Asian low and this is the London low. I'll tell you how I found out later, how I know that this is the Asian low. So if we're having this to be the Asian low and London low, and aside that, beneath that is also an FVG. There's also an FVG on the 4-hour time frame. So I think our direction is very clear. We're heading downwards. Okay, so where are we in price, and what is the next thing that would happen before we head downwards? So we strip down again to the 15 minutes. On the 15, this is where we mark out the time we come into the market. So I come into the market at 8:30 Eastern time, 8:30 New York open, which is usually my kill zone open. This is like ICT. I trade ICT. So I'd literally want to push that behind so we could have our charts in front. I want to have my charts in front. Okay, yes. So that's good now. So you could see that exactly at 8:30, we had liquidity run to the upside, which this liquidity happens to be London highs. So you'd wonder, okay, how am I knowing that these are London highs and London lows and the session highs and lows? Now, when I have my period separator and my midnight open, this is my Asian session. Okay, this is Asian session. This is London session. And then from the Q zone open to the period separator again is the New York. Okay, is the New York. And then Asian starts again, and then it just keeps on going on and on and on. Yes, I know that there are little sessions like the Frankfurt and the Sydney, but then I don't take note of them because they are very small and they don't even fall into my session. I trade only the New York session, so I don't need any of this. All I just need is, okay, what happened in London for me to trade, to know what's likely going to happen in New York. I don't need all of the Frankfurts and the Sydney. I don't need them. All right. So we have price ran the London highs, makes it very simple. Mind you, if price came at 8:30 and tapped into this fair value gap, I may consider the buys. Okay, I may consider the buys if price came in. If price came into the fair value gap, I may say, okay, we may need to buy to retrace a little before the sales continue. So I had a two-way bias, but then it's more, I'd love to sell more. And price just presented me with that. And as we grabbed this liquidity right here, I'm done with the 15 minutes time frame. I need to strip down to my entry time frame now to see where I'd likely get a trade entry. So I'm right here on my entry time frame. What do I really look out for a trade entry? If this was liquidity and price found its way up to grab liquidity, I want to see a previous low taken and a return to fair value gap that would be created while price was displacing this low. And on the mitigation of the fair value gap, I would have my sell entry, my stop loss above structure, and I'd sell towards target liquidity. That's my simple trade entry. So let's see if we had that created for us. Now over here, my entry time frame, this was where we had price grab liquidity. Okay, so I'm actually now looking out for a break of structure. Now if you scalp, you need to pay attention to details. This is literally an hourly price movement. So yes, I did get a break of structure here. But if you're looking at it from a perspective where you're not taking attention or paying attention to details, you not spot that. And then this is not a break of structure here. This is not a break of structure if you're thinking about it. I tell you why that's not a break of structure. Because look at this. This is the actual low. This is the actual low, not this. So it is not a break of structure. The break of structure had occurred already. So where is my fair value gap? This is the fair value gap that I'll be looking forward to take price from. Right here. Now I'm not taking this because of I try to maximize my risk to reward. I want to have a minimum of 1 to 2. So if I have my trade entered, my trade entry from here, I'd literally not gain much of the move. So it's better I stay off completely or I have a banger risk to reward. So I knew that, all right, my risk to reward will cover for my losing days. So if this was my fair value gap, I really expected that price would just come into it like this around this period and go. But then the market was choppy and consolidating so much. But then I looked at the time, we were not around 9:30. So I was saying, okay, at 9:30, probably we'll get a push up and then I could sell. At 9:30, I almost lost hope because this is 9:30 right here. You can see this is 9:30 and price was still very, very choppy. Instead, it was even looking like it was going to go down. When I looked into details, I noticed that we had liquidity created here, above and beneath. So most likely price will just grab those liquidities and sell. So I was very, very, very confident at that point. My trade got triggered here and I had my stop loss just above. And my take profit was at the initial target we marked from the 1 hour And this, mind you, inside here now is inside our fair value gap, the 4-hour fair value gap that we spoke about. And look, I actually got filled at the end of the day, but that wasn't my business. All I wanted to do was take price till it got to the equal lows. Okay, now you may say, is this not too late after having all of this consolidation? Yeah, I had similar thoughts. My students in the VIP were asking, wasn't I going to wait for another confirmation? And they'll be thinking, why is he actually taking a trade off of this? Now, because I understand the indices markets very well, and I've been trading the indices market for a long time. The market doesn't move anyhow. The market moves with precision at certain times. The market could consolidate and be very, very random at any random time, but then at certain times, and at this time, the key time here for me was 9:30. So at 9:30, I knew that, okay, if 9:30 moves the way it usually does, I would not get any of this. 9:30 is very swift. If you trade indices, you know it. 9:30 is a very swift time in the market because it's the equity open. So if actually this trade got activated at 9:30, I would not have, there will be no room for waiting for another break of structure. Mind you, the market has told you that, okay, we're intending downward, and then you know that you're intending downward, plus other markets were correlating for bears. So I wasn't just willing to take this. But if I had waited, obviously I'd have gotten an entry here. Okay, you could see that this was now the fair value gap that was created, and then I could now take myself entry. Yes, I'll bank higher risk to reward ratios, but is there longevity in waiting for a second break of structure? No, you'd miss setups. Now you could literally see that this is a 3-hour trade, and then what I took was almost a 3-hour trade too. So yes, this is 3.4 and this is 3.6. Yes, I'd make more money on the setup, but then we're looking forward to consistency and not just a one-time home run. Just what I've shown you right now is all you need to scalp effectively. Literally, let's go back to the higher time frames and see what the trade looks like. Let's see the 15 minutes, and you see that it's exactly the trade I showed you that I took. And this is it right there. That's what we have. Go back to the beginning of the video and check the exact same trade. This is how scalping is done. Now that you've learned what it takes to scalp effectively, I need you to stop whatever you're doing and go study what you just learned and see for yourself. You may have questions as you study, so join my free Telegram community or reach out to me directly on Telegram so I could clear your doubts.